it. My working title while I was working on it was China, everything you never wanted to know, but I will tell you anything. Anyway, yeah, so as we were talking beforehand, I have been in and out of China professionally for the last 25 years, and for the last 15 years I've been running a company called Dragonomics, which specializes in analysis of China's economy and political environment for a financial and corporate audience. And I've been looking for a while for an opportunity to take the scattered thoughts of all of these years and boil them down into something coherent. So when Oxford came to me and suggested that we put this together, it was a very welcome invitation. And it's been a very gratifying experience, both to write it and also, now that I'm trotting it around to various audiences, to engage in discussions with people about, partly about how China got to where it is today, but more importantly, where it's headed. And that's essentially what I'm going to discuss today, is lay out my understanding of how China achieved what it has already achieved, which is in many ways extraordinarily impressive. What the challenges are, and the challenges in China are always great, but I think they're greater now than ever because we're at a number of important transition points. And then how things might play out in the future, and then I hope we can engage in a little bit of discussion about what other people's angle of vision is on this. So first, it is important to lay out my understanding of why and how China grew. And I think there are a few factors that you can abstract from the morass of detail that provide an explanation of just how they were able to succeed in growing at 10% for 35 years almost, which is pretty much an unprecedented record. But it's very similar, actually, in many respects, to the record of other countries in East Asia, notably Japan, South Korea, and Taiwan. And that's kind of the starting point. That a lot of what China did was actually a very standard recipe. There's nothing complicated about it. They took what development economists call the East Asian Developmental State Model, which is a term that was coined to describe the post-war experience in Japan, South Korea, Taiwan, and so forth. And basically what this model involves is, first of all, equitable land distribution, so that you get small-scale farmers who, when you have a lot of labor, they are actually much more productive than large plantations. So when you have small-scale farmers, they generate a very large surplus of savings. And then if you have a financial system that can capture that savings and then move it into strategic investments in infrastructure and basic industries, and most importantly, in export-oriented manufacturing. That's how you generate growth. And the reality is, if you do a study of successful development over the last 200 years, there is essentially no other proven way to get rich. The East Asian Developmental State Model has its roots in the model that Bismarck's Germany used to develop, which was pioneered by an economist called Friedrich List, who in turn derived a lot of his ideas from an examination of early 19th century United States. So this notion that you can develop by taking an agricultural surplus, investing it heavily in infrastructure and basic industries, and then focus very much on export-oriented manufacturing that forces your companies to become more competitive. This is basically how you get rich. So when China was looking around in 1979 for how to get out of the stagnation of communist style of growth, they saw models in their neighborhood, liked to look at them, and basically copied them. There were two significant modifications that China made to the standard East Asian model. One was that they were much, much more open to foreign direct investment. So Japan, South Korea, Taiwan basically did not have any foreign companies operating within their boundaries. Most of their success came from the homegrown firms. China, conversely, and famously, allowed a great deal of foreign direct investment, and at the peak in the 1990s, foreign firms accounted for about 1/6 of all fixed investment in China. extraordinarily high number. And even today, foreign invested firms account for nearly half of China's exports. The second big difference was that China relied much more heavily on state-owned enterprises. And this was a reflection of its history, obviously, as a communist country, because at the starting point in 1979, they had a lot of enterprises, and they were all owned by the state. So you either had to privatize them, or you had to keep them around but make them work better. And the Chinese made a quite conscious decision not to engage in mass privatization, which was different from the decision made by other so-called post-communist transition economies like Eastern Europe and the former Soviet Union. And they did so against the recommendation of many Western economists who saw private ownership as the key to a successful market economy. I think the Chinese recognized correctly that private ownership was less important than competition. And if you introduce market mechanisms and competitive forces and force state-owned companies to play, at least to some extent, by the same rules, that you could maintain a high degree of state ownership of assets, but you can improve the efficiency of the economy. So it was sort of a combination of this classical East Asian developmental state model that they borrowed from Japan and Korea principally, and this kind of pragmatic decision to, instead of privatizing assets, create market competition that allowed for a gradual shift in the balance of power between state enterprises and private companies. And so over time, although you started out with 100% state ownership, you moved gradually to a system where private companies got more and more space to operate and were more and more successful. And this is sometimes been called growing out of the plan. So instead of getting rid of the old system, you keep the old system in place, but you let other new things grow up around it. This has proved to be very successful. Final element, I think, in the formula was that when you look at the governance structure in China, it is this very odd combination of a highly centralized, highly powerful Communist Party at the center that exercises a lot of authority, and an extreme amount of decentralization at the local level. And anyone who works in China for more than 5 minutes is keenly aware of this. And what this enabled China to do was essentially take advantage of the benefits of both kinds of things. So when you need to mobilize a lot of capital for infrastructure and build a high-speed rail network or an interstate highway network, the power of the central government comes into play. But when you need more diffuse or ground-up entrepreneurship, the fact that a lot of economic activity is decentralized and not really subject to central control is very beneficial. And China, uniquely among developing countries, was able to combine the power of a centralized state with the kind of bottom-up dynamism of a relatively unconstrained private sector. The other point that I think is really important to understand, particularly as we look ahead at China, is that economists have a tendency, and I should first of all stipulate that I never took an economics course and I'm not really an economist, I just play one on TV. But economists have a tendency, I think, often to look at things in an overly rationalized framework and ignore the importance of the underlying political bargains and political constraints in how countries actually develop. And I think there are a couple of aspects of the political situation in China that are very important to understand if we want to really comprehend the economy. And the two, I will highlight two. The first one is domestic, and it is this tension between a Leninist authoritarian communist party that wants to maintain an absolute monopoly on political control and control of most aspects of society. So you have that on the one hand, and on the other hand you have this increasingly dynamic, robust economy which depends a lot on private entrepreneurship. And for years, for as long as I've been in and out of China, since the mid-'80s, people have been coming to China saying, this cannot possibly last. You cannot possibly have this control-obsessed authoritarian state on the one hand, and this dynamic economy on the other. They will come into conflict And sooner or later, either the political system will break up or the economy will stop growing. And it's a very plausible, logical point of view, and it's been wrong for 30 years, or more than 30 years. And the question is why? And I think it boils down to how the party conceives of its interests. So it's true that their principal goal at all times is to maintain the monopoly on power. But very close behind that is the goal of economic growth. And there are two reasons why they need to maximize economic growth. The first, I think, is rooted in Chinese history. Chinese elites since the mid-19th century had been grappling with the problem of the fact that they were one of the leading economic powers in the world for centuries, and then suddenly in the 19th century it all fell apart, and they fell way behind the West. And so it's been a preoccupation of Chinese elites since then to restore China to its rightful place. And most Chinese elites, I think, whether in the Communist Party or of any other persuasion, have recognized that economic growth is really a prerequisite for regaining that lost stature. The second is that, more pragmatically, the Communist Party has engaged in at least two major studies of the fall of the Soviet Union, and with the purpose of understanding why it fell so they can avoid doing those things that made the Soviet Union fall. And among the conclusions that they reached was that a failure to manage the economy properly and a failure to raise living standards and create a technologically progressive economy was a big reason for the ultimate collapse of the Soviet Union. So the party, I think, has a somewhat more complex view of the economy than is often understood. When they face this trade-off between their desire for political control and the need for economic growth, they have proved quite willing over the last 35 years at various points to tactically surrender various bits and pieces of control over agriculture, over manufacturing, over prices, in the late 1990s over state-owned enterprises, over significant parts of the trading system when they entered the World Trade Organization 15 years ago. And they've been willing to make these tactical retreats from control because they calculate that if they get more economic growth, that will enhance the legitimacy and control of the party in the long run. So there's been a great deal of skill at the top of the system in balancing the objectives of control on one hand and growth on the other. And as I'll say later, I think one of the big challenges that we see right now is that there's a need, once again, for that trade-off between control and growth. And the current leadership seems rather more reluctant than past generations to make that trade-off. But over decades, they did a pretty good job. The second political issue, which I think really people don't pay enough attention to, is China's geopolitical position and how this constrains its economic choices. And one of the reasons that China, I think, allowed a lot more foreign direct investment in, as opposed to what Japan and Korea and Taiwan did, was they had a very different political situation when they decided to get on the development track and join the global system. Japan, Korea, and Taiwan were all parts of the U.S. alliance network. They essentially had a security bargain with the U.S. under which they provided kind of the front line of the U.S. security perimeter in East Asia, and in exchange they got freedom to do pretty much what they wanted economically, great access to the U.S. market, and no particular compulsion to open their markets to U.S. firms until they got quite rich. When China entered the scene, that deal was not on the table. They were an independent geopolitical actor. They had to pay some other price of admission to the global system, and I think opening up their market was part of the price that they paid. And now, China is still an independent geopolitical actor, but it's got a much stronger bargaining position, and I think this now affects its attitudes towards foreign direct investment and towards economic development generally. Okay. So that's a very, very simplified version of how China got to where it is today. I've left out a lot, obviously, but I think those are some of the key factors. where are we now, and where might China be headed? Well, where we are now, I think, is at a couple of very key turning points. And there's one, the first one is often characterized in the financial media as the need to rebalance from an investment-led to a consumption-led economy. And for various technical reasons that I won't bore you with, I have objections to that particular formulation. The way I tend to think of it is that China, essentially for the last 35 years, the principal economic task has been to mobilize resources or to accumulate capital. And the simplest way to quantify this is that you can take a look at, you can measure the total capital that exists in an economy. So this would be infrastructure, factories, houses, and so forth, all the physical capital. And then you take the value of that and you divide it by annual output, or GDP, and you get what's called the capital to output ratio. What you find is that rich countries like the United States or other OECD economies typically have a ratio between their capital stock and their annual output of about 3 to 1. Poor countries have a lot less capital, and that's why they're poor. So the first step in going from poor to rich is to build up your capital stock. So you invest a lot, you throw in a lot of new roads, new railroads, ports, electric power plants, steel plants, petrochemical plants, all very capital-intensive, expensive stuff. And gradually you get to the point where your capital stock is big enough to support a much larger economy. And while you're doing it, you're running a very investment-intensive economy, and having a big state that's very powerful and a lot of state-owned enterprises that can invest for the long term without worrying about whether this is going to turn a profit in 3 months or so is very useful. So China has been very, very good at accumulating capital. They now have the world's biggest high-speed rail network. They have an interstate highway system that's half again as big as that of the United States. They have the world's biggest steel industry, et cetera, et cetera. I think we all know these things. The problem is that the capital accumulation phase always comes to an end. You get to the point where your capital stock is big enough. You don't need the next mile of road. You don't need the next port. You've built stuff that can support a lot of economic activity. And then you stop getting any economic growth simply by building new capital projects. And that every country that has grown has faced that problem. And China is now kind of at that point where the return on each new infrastructure investment is much, much lower than it was before. So the next phase of growth is getting growth from maximizing the return on the capital that you've installed. So it's all about efficiency and productivity. And the problem there is that the tools that were very, very useful when you were building up your capital stock are no longer so useful when the job is to take that capital stock and just generate a higher and higher return. And fundamentally what it means is that you need less involvement by the state. You need more private enterprise because private companies always generate a higher return on their capital than state companies because they have only that one objective in mind. And you need to rely much more on market mechanisms to set prices and allocate resources. So it's a big, big adjustment. And when people talk about the middle income trap, which is also a concept I have some difficulties with, I think basically what they're talking about is this. It's very difficult to make that transition from the building phase to the maximization of return phase of growth. So that's kind of the economic task that China faces. There are two other transitions that I think are also, one is inevitable and the other is desirable. The inevitable one is demographic. So another factor in China's terrific growth record of the last 35 years is they had a younger and younger population. So they had a huge baby boom in the 60s and 70s. Then fertility rates fell, partly because of one-child policy, but also because of other factors. And so the proportion of the population that was of working age rose quite a bit. So you had more workers, you had less dependent mouths to feed, and that's called the demographic dividend. And when you go through that period, often you experience very, very high rates of growth because you have a lot of productive workers and not too many costs of young and old people. But China is now heading into a demographic transition where it's rapidly aging, and this demographic dividend is turning into a demographic tax. And as I'll show in a minute, this is an extraordinarily rapid transition, and it will be very difficult to go through. So China has the problem is it has a very difficult economic transition to go through just to get from the capital mobilization to the capital efficiency stage of growth. But on top of that, they have this big headwind in demographics. Then the third transition, which is desirable, but I think unfortunately not very likely, is that one of the ways to make these transitions to a more efficiency-oriented, consumption-oriented economy is to make your government's structure a little bit more responsive and inclusive. And I think in order to achieve the economic transitions that are required, some adjustment in the political arrangements is going to be necessary, but at the moment we don't see that happen. Okay, so I'm going to show a few pictures, not too many, just to illustrate these transitions. So this is my illustration of why we're at the end of the age of capital mobilization. And this is a picture of housing construction in China. The blue line shows annual completions of rural and urban housing. And you can see it rose very steadily for many, many years. And between the late 1990s and about 2012, it about tripled. And this correlates almost exactly with the huge increase in Chinese steel use, the huge increase in its imports of iron ore, coal, and many other commodities, and what's called the commodities super cycle over the last decade or more. We've built a model of where we think housing demand is going, and I won't bore you with details. If you're curious, we can discuss that later, but we think it's a very robust model. It's held up quite well over the last 2.5 years since we built it. And basically what it tells us is that we've reached the peak of housing construction in China, and it will have to decline. The annual construction of housing will have to decline by about 15% over the next decade. This is not disastrous. There you can see, even at the end of that period, that it's still a very high number of annual housing construction, but the point is it's not growing anymore. So you don't get any growth in the economy from building more stuff. You know, and what applies for housing applies basically for all of infrastructure. We're getting close to the peak levels of annual construction needed for all of these things.
What's your urbanization assumption in that?
The urbanization assumption is that we get to about, right now we're slightly over 50%. The assumption is we get to 70% urbanization by 2030.
So roughly 20, how many people a year? 20 million a year?
Probably about 15 million a year. So we've just basically used the Chinese government's urbanization assumptions, which are already turning out to be a little bit too optimistic. It's slowing down. So that's the end of the building boom era of growth. This is the demographic thing. Again, without being too complex about this, demographers have something called the dependency ratio. You take the number of people who are under the age of 15 and over the age of 65, and you say how many of those people are there relative to the number of working age people. So in 1975, there were 8 of these young and old dependents for every 10 workers in China. Over the next 35 years, that number fell in half to 4. That's the red line. And you can see it's all because there was a decrease in the number of young people, and this was because of birth control policies and lower fertility. The line is where we are now, and you can see that number is rising over the next 20 years, and it's rising entirely because of an increase in old people. So China is a very rapidly aging society, and so while the dependency ratio is going down, you have a natural tendency to grow quite rapidly. When it's going up, that is a headwind to growth.
Did this chart change when China created its two-child policy?
No, and that's a question that I often get, and I think that's completely irrelevant. They can do nothing to raise the fertility rate through policy, because no country ever has. We could discuss that later if you want to challenge me on that. But,
I know some hospitals in China that don't agree with that.
They're here and there, but on a macro level, unlikely to have much impact. And this why you need less state and more market. I'm not a market fundamentalist, but what this shows is the return on assets among state-owned industrial firms in the red and private firms in the blue. What's interesting is that for a decade up until 2008, you can see that both numbers were rising. So all companies, whether private or state-owned, were becoming more productive. They were getting greater return on their assets. Everyone had a tough time, and obviously in the global crisis of 2009. But then after that, private companies bounced back and have maintained a very, very high return. State-owned companies bounced back a little bit, and then they just started to deteriorate again. And basically, why did this happen? It's because state-owned companies are the agents of infrastructure building, and the return on new infrastructure projects is just not as high as it was 10 years ago. So this, I think, tells you that you need to take resources away from the state sector, which is basically investing in lower and lower return projects, and move it into the private sector. And I might add one other point on that, which is that a lot of people are concerned about the debt problem in China, and I will discuss that a little bit more in a few minutes. But to boil it down, the debt problem is largely a problem of state-owned enterprise borrowing. They borrow on average almost twice as much as private companies, and they deliver a return that is only 1/3 as great. So if you're borrowing twice as much and delivering 1/3 of the return, it's pretty easy to see that that is a big problem, and that helps explain why the economy is slowing and the debt is rising. Okay, so those are the economic challenges. Now, where might things go? Basically, it boils down to whether the Chinese government is willing to execute a series of pretty substantial structural economic reforms to shift resources from the state sector to the private sector, increase competition across a whole range of sectors, deregulate many sectors, particularly in services that are dominated by state companies and could use more infusions of more entrepreneurial private capital. Change the fiscal system so that local governments are incentivized to promote consumer spending and services rather than building the next aluminum smelter. And financial sector reforms to clean up bad debts in the banking system, recapitalize the financial institutions, and ensure that they are lending to the most productive enterprises. So that's a tall order. The government laid out essentially that menu of reforms about 3 years ago in the third Plenum reform decision of November 2013. And at that time, a lot of observers, including myself, were very optimistic that once again, the government was facing this trade-off between control and growth, and once again they were saying, well, we're willing to give up some control over parts of the economy to get more growth. So the signs look good. Since then, the progress in most of these areas has been very disappointing. And again, I won't get into details, but it's really been not good at all. And growth has been sustained at the current level mainly by more and more lending, more and more debt accumulating, and this is clearly not sustainable. So the question fundamentally is whether the government in the next 2 or 3 years gets its act together and starts implementing these reforms more aggressively or not. So with that basic sort of pivot or decision point, we can spin out a few scenarios about where China might go over the next decade. And I should stress, for those of you who have been engaged in scenario planning exercises, and I'm sure there are a few of those in the room, you will know that the one thing that is true about any scenario is that it will never come to pass. It is an artificial construct. So these are not forecasts, but these are ways of organizing, discussion, basically, about possible pathways. Okay. So the first scenario I call Singapore on steroids. And what I mean by this is that China basically tries to organize itself like Singapore, except on a much larger scale. They do the economic reforms. They reduce the role of the state sector. They control the growth of the debt. And by early in the next decade, China's growing at about 5% a year, and debt levels are stable. That's a very successful outcome. And it probably implies some liberalization in things like the media and the judiciary, but not very much necessarily. I think that would be good for most Chinese people. It would be good for a lot of the rest of the world, which would benefit from Chinese demand. I think it could be challenging for the global political environment because a successful China would also be more more assertive China in foreign policy. The other two scenarios are basically variations on the theme of what if China does not do these reforms that they need to do, and therefore the economy stagnates or slows down dramatically. And so one scenario which some people in the foreign policy community here are beginning to talk about already is that China turns essentially into a variant of Putin's Russia, where the government no longer can gain legitimacy from a booming economy, so they gain legitimacy from aggressive nationalism and foreign adventurism. And obviously this is a very bad and destabilizing scenario. I actually think it's by far the least likely of these three, because I think if the reforms fail to take root and you get economic stagnation, what is more likely is what I call the Japan 2.0 scenario, which is that it just becomes too politically difficult to untangle all of the power dynamics necessary to do the reforms. So growth slows, debt continues to rise. But the government responds to this not by saying, oh, we have to go start some war somewhere else, but they say, oh, actually, people are going to be really unhappy at home. So we have to spend more money, more government money to keep them happy through more bridges to nowhere infrastructure projects to keep people employed, or social welfare spending, or whatever. But they become much more inwardly focused, pretty much as Japan has done since it hit the financial wall in 1990. And I think that if something bad happens in China, I think this is the most likely scenario, more likely than the retreat to nationalism, more likely than a sort of a dramatic financial collapse. So just to conclude with a couple of comments on, since this is my most interesting scenario, how likely is it really? And I think you can find some interesting similarities and some interesting differences between China and Japan. So one is, if you look at China developmentally, its level of income, technological development, etc., it's like Japan in the early 1970s. And what that means is Japan in the early 1970s still had 2 decades of approximately 5% a year growth ahead of it. So I think if you do any kind of analysis of potential growth rates in China, if they get policy even partially right, it's pretty high. There's a lot of growth that China can pretty easily capture from obvious sources. Demographically, however, it looks more like Japan a little bit later, 1980, and I'll show you a chart on this in a minute. But then financially, it does look a lot like Japan in 1990 because you have a huge buildup in debt that seems not sustainable. And there are a couple of other features. This intermeshing of government and big business, which in Japan took the form of the government and the keiretsu companies. In China, it's the government and the state-owned enterprises. There are a lot of analogies there, and it's difficult to unwind. There's also, I think, a little bit of a tendency in Chinese elites or some quarters anyway, to say, well, you guys had a free market economy in the US, and look what it got into a financial crisis in 2008, and we're much smarter because we realized that the state must have a bigger role and we're safer that way. And you heard a lot of that kind of talk in Japan in the late 80s and early 90s, that they'd come up with a superior model of capitalism, and that didn't turn out so well. So hubris is always dangerous. So again, just a couple of quick pictures to illustrate these points. This is a little hard to read. Basically, the red dots are China. All the other dots are big East Asian countries. It plots growth rates against how rich you are.
Red cubes.
And red cubes, thank you, squares. And the basic point is that when other countries in Asia got to China's current level of income, they were still able to grow by at least 5% for another 15 or 20 years. So again, this supports the potential growth argument. So that's good. China has a lot of room to play with. This is demographics. This is bad. So I showed you the dependency ratio before. This is another way of looking at it. This is the ratio of people of working age to people of retirement age. So how many workers are there to support each retiree? China today is about 6 to 1. That's the same as Japan in 1980. 25 years from now, one generation hence, it will be 2 to 1. That's the same as Japan today, and it will be less than the United States in that year. And that is an extraordinarily rapid demographic transition. I don't think any major economy has gone through a transition that rapid. This is 10 years more compressed than the time that it took Japan to go through this. I think there are ways that this can be counteracted in the short run, but in the medium to long term, this is a very, very severe problem. And this is just the debt levels. I won't bore you with it. The red line is China. You can see it's risen very quickly, and it's incredibly high. So we all know China has a lot of debt, and that's a problem. Conclude, though, with a couple of comments about why the outcome might be different. So one is clearly China does have a lot of growth potential. So if they do a few of these reforms, they'll turn out fine. Second big difference is that Japan ran into trouble in 1990 because they had a ridiculous asset bubble, which popped. Famously, the land under the Imperial Palace in Tokyo was worth more than the state of California, and then it wasn't. And asset prices fell by about 3/4 over a space of 3 years, and that was a catastrophic event, Great Depression-style event that made it much more difficult for Japan to adjust. China doesn't have that particular problem. They have more room to maneuver. And then the final point is that, again, getting back to this geopolitical independence, Japan was rich enough and secure enough because of the U.S. security umbrella that they could afford not to solve their problems and basically go into this period of no growth, but everyone is pretty well off and the country was safe. China doesn't, I think the leadership don't feel like they are in that kind of secure position. The country is poor, they have to take care of their own security, so the costs of messing up the economy are much, much higher. So I'll leave it there. I think we have some very difficult transitions ahead in China. I have some grave reservations about the willingness of the current government to make the changes necessary. But as I've just suggested, the potential for success is there, and the incentives are very powerful. So it'll be interesting to see how it plays out over the next few years. Thank you.
Arthur, thank you so much for really a very clear exposition. 2 comments. One, I don't think the analogy to Korea, Japan, and Taiwan is accurate. I think because they were part of our security umbrella, we allowed them to get away with basically closed environment. I think that part may be true, but China didn't pay a price for being open to foreign investment. It got an enormous benefit from being open to foreign investment. The Chinese leadership, when I moved there in '79, made a decision. This was a way to jumpstart the economy, that they were technologically decades behind the United States, Japan, and Europe, and this was a way to jumpstart it. So I don't think that is correct. I think the analysis understates the importance of the private sector. I think you're overstating what the state sector has done. That for years, it's not the majority of GDP. This is not the last 2 years, the last 15 years. It's not the majority. I think Nick Lardy's book, Markets Over Mao, talk about the role of the private sector and how that really has been the miracle of China. And why that's important in today's analysis, in my view, is that the private sector is what's driving the economy today. That we actually, when I go around China, there is contraction. It's not slow growth. There is contraction in steel, aluminum, cement, building materials. There's actual contraction. But we're seeing, because Xi Jinping's government has wiped out rules relating to the establishment of businesses. We don't give them enough credit, but we see hundreds of thousands of new businesses being created every few months. And that's where the economic growth is coming. And I think that they understand that. They understand that the state sector is moribund, but they're kind of faced with, I think what you correctly point out, is entrenched interests that are in opposition to reform. I mean, if you're a monopolist, you don't want reform. Heck, life is pretty good as a monopolist. I like monopolies as an old investor. So when I look at the 3 scenarios, I kind of say, well, it's probably the one where reform kind of inches along and we continue to see growth at the 5-6% rate. What do you think of that kind of analysis?
Yeah, well, I think that's a valid point. I struggle with this a lot because this is one of the great contradictions of China. You have this very large state sector and you have this very large private sector who's in charge. And I've read Nick's book very carefully, and I have a lot of respect for his detailed work. However, I differ. The private sector is an aggregate of very large. It is also incredibly fragmented. The state sector has shrunk over time, but it's highly concentrated. So when we talk about influence over the political system, the state-owned enterprise sector has a weight that far exceeds its contribution to GDP. And I think looking at this in terms of output fundamentally is the wrong way to look at it. What you need to look at is command over resources. What share of inputs do state-owned enterprises get relative to output? And they get a lot more than they deserve. Right? They have still the majority of bank lending goes to state-owned enterprises. That share has been shrinking, and you can go down the list. Their access to resources far exceeds their contribution to output, and that I think is that's a problem I have with the output analysis. The other comment that I would make is that I agree with you on sort of there's been a huge surge in private business creation. And that's great, and that is directly related to some reforms that have been taken the last couple of years. But creation, market entry for private companies has never been the problem in China. You've had a very high rate of private business creation for decades. The problem is market exit for state firms, which there are huge barriers to exit for state firms. So again, this enables state firms to suck up far more resources than they are entitled to. So when I added all, the other thing is when you look at the state sector, it's smaller. Relative to GDP, China's state sector is twice as big as the state sector in any other economy in the world. Number 2 is India, right? So it's smaller than it was, but it's still gigantic in any comparative analysis. So, and it's the degree of political power that it wields and the degree to which people within the Communist Party leadership, not all of them, but many of them, are convinced that a very large state role is essential to technological development and economic growth, I think is contradictory fundamentally to the goals of economic reform. So I think it's not just a case of, we have some wise reformers who have the right idea, but they're up against some bad guys. I think right up to the top, there is a deep conflict in the views of the Chinese leadership about how to resolve the relationship between state and market.
Can you comment on his first comment about Asia, the Asian development model? Remember Steve's first comment?
Well, yeah. So yes, they gained a benefit, but they also paid a price to get that benefit. And I think it's certainly I
would argue they paid almost no price.
I don't think that's the way that the leadership in China sees it, and I think that sovereignty and autonomy has always been a very, very important goal for most economies, but particularly in East Asia. And I think the fact that you have these large companies, there's gigantic resentment, for example, that foreign companies in the technology sector are able to extract gigantic royalty payments for their technology. There's enormous resentment that China has been stuck in the sort of the assembly stage of technology, earning pennies on the dollar for assembling an iPhone that Apple can then turn around and sell for $600 in the US.
But they allow Apple to sell $15 billion a quarter? Seems the numbers speak for themselves. There may be this resentment, but they've effectively allowed something that no other developing country has allowed. And they've allowed General Motors, and they've allowed in the old days Motorola.
Steve,
In other words, we need.
The point is not here to debate whether they were the net beneficiaries or not. The point is, what I was trying to explain is why did they make that decision which the other countries did not make? Right? They all grew, and they grew stylistically in pretty similar ways. But China made a decision that the other countries that it was directly emulating did not do, which was to allow much more foreign access. And I think, their technological backwardness, I agree with you. I think they looked around the world and they said, we are just so far behind. There's no way we can catch up. I think that was an important factor. But I think understanding the different geopolitical positions of China versus the other East Asian countries is a very, very important part, not just for this analysis, but for a whole range of questions that relate to U.S.-China relations, frankly.
Yeah. The reason I react to that view is it's always interesting to me as we have this debate over China in the election today, and the fact of the matter is exactly as you point out, that China has been more open to U.S. investment than Korea, Japan, or maybe Taiwan is a closer question, but clearly Japan and Korea. You walk around Shanghai and you see General Motors cars. You walk around Tokyo, you don't see General Motors cars. It's a whole different ballgame. Let me open the floor to questions back here.
Hi, my name is Alex Rotter. I'm a big fan of yours. I think if we talk about shrinkage across many different topics, one topic we didn't quite mention is the trust and confidence. I think the shrinkage in trust and confidence in CPC has been the biggest I have seen over the last 30 years. And now even the senior people confide privately how little they trust. And I think that's going to add to the complexity of transition that you just talked about.
Yeah.
And it's also the cost of mistakes is amplified because of the lack of trust and the size, all the things that you mentioned. So this was apparent in the stock market problem last few months. Would you like to comment on that perhaps? Why is it not being discussed? Because this is a multiplier factor in my view.
Well, I think you're touching on a rather deep social issue, which I'm not entirely qualified to address. But I think a lot of sensitive observers have noted that China is a fairly low trust society and has been one for a long time. And I think a lot of that can be laid at the feet of the Cultural Revolution, which really tore the social fabric apart. And a lot of people then in subsequent years and decades had to deal with people who had tormented them during the Cultural Revolution, and so you could never be quite sure, when someone was going to flip. So I think that's been a chronic problem, and as long as I've been in China, people have talked about this. It may have gotten worse in recent years because of the huge increase in corruption, particularly in the latter days of the Hu Jintao administration. And I think part of the reason this vast anti-corruption campaign that Xi Jinping is doing is to try to create a more disciplined, in a sense, trustworthy Communist Party from the standpoint of the population. I think a lot of people like the anti-corruption campaign and are glad to see people being thrown in jail. I think most people are still quite cynical about the sort of the underlying venality of most people in government. So I don't think that they've completely solved that problem. But I tend to think that the trust problem is more of a chronic one than one where we're seeing a negative trend. But as the economy becomes more complex and various, it is important to have higher levels of trust. You can't really have a successful financial system or a successful system of contracts unless there is a baseline degree of trust that's a bit higher than you see in China today. So then, ultimately, I think that boils down to a governance problem. You need to come up with some ways, even if it's within the continuance of the one-party system, to improve the reliability and predictability and trustworthiness of the governance structures. And if you can get that, and that's kind of what they've done in Singapore, and that's why I threw that word in, it is possible to do that. But it's a big job.
Tristan.
Hi, I'm just curious if you can talk a little bit about how fast you feel the Chinese RMB is accelerating in terms of becoming a more influential currency in the basket, and how that's going to affect the economy moving forward.
I think at the moment it's heading backwards, to be honest. So there was a move to internationalize the use of the renminbi following the global financial crisis. I think there were a couple of motives in there, but I think a very large proportion of what was going on was the central bank was trying to push domestic financial reforms. They were having a hard time doing it. And so they figured out that if they created an international market for the renminbi, where interest rates were set not by the government but by market players, that they would be able to force the pace, ultimately, of domestic market liberalization. And I think they sort of they achieved a lot of what they wanted to do when the renminbi was included in the SDR basket, the IMF's SDR basket. And as a result, they had to complete the deregulation of interest rates, and in a formal sense, they had to allow the renminbi to trade a little bit more freely. The problem is that this comes back to this trade-off or this conflict between, growth and control. In August, they set up a situation where they said, okay, we're going to let the renminbi be more market determined. And what that means is that on day one, we're going to have to devalue it by 2%, because that's what the market said the rate was. And basically, global markets freaked out, and the government had to jump in and say, oh, well, actually, we want a market-determined exchange rate, but we also want to guarantee that the rate will be stable. And you can't have both. It's impossible. And that is the position that they're in now. And the way that they ensured the stability of the rate was that they shut down, effectively, the offshore market. Because the problem they had was that the onshore market, they could control. The offshore market was trading at a big discount. That was very embarrassing. So in January, they just got rid of the liquidity in the offshore market. So I think the problem that they're in right now is until they figure out a way to get comfortable with the notion that a more liberal exchange rate regime means more up and down, more volatility, they're going to bias towards control, and that's going to limit their ability to internationalize the currency. You can't have a controlled currency that is also usable in a broad sense internationally.
David.
Hi, David Zweig, Hong Kong University of Science and Technology. Thank you. Terrific. I agree with a lot of what you said, learned some stuff. My question, though, is about information flow. So we're now in a situation where...
You need to hold closer.
Okay. We're now in a situation where I think people are afraid to speak the truth, where think tanks probably have a hard time reporting what's really going on, where the leadership doesn't want to hear bad news, right? We've been told that you can't give bad news. And how does this figure into your scenario? I mean, it should reinforce the inability to make the proper decisions.
Yeah.
So,
I think that's a huge problem, and I think that has gotten worse over the last 2 or 3 years. And it's always been an issue in China, obviously, but there's been much more control over the internet. There's been control over academia. There's been, a lot of ideological control over the think tanks, like the Academy of Social Sciences. If you're getting bad information and preventing yourself from hearing the truth, you're going to make bad choices. And the ultimate example of that in China is the Great Leap Forward, right? And what scares me a little bit is with all of these recent edicts to, bank economists that they should only say good things and other things that we kind of hear in the background. It's a little bit like there is an effort to crowd out the bad information. Now, I think in reality, once you get to the senior levels, they have a pretty good sense of what the score is. There are a lot of information mechanisms that continue to function internally. There's, as you know, there's zillions of surveys that people are doing all the time on all kinds of topics. The 5-year planning process, which just concluded, is a massive information gathering process. So I don't think we're headed back to sort of 1950s levels of distortion in understanding what's really going on. What it comes back to, again, I think, is that if you want to have a society or an economy that's driven more by innovation and creativity and new stuff, and you're spending all your time telling people, oh, you can't think that, you can't say that, you are not going to get that kind of growth. So it's a real impediment. There's a real contradiction between what the government says it wants in terms of innovation-driven growth and what it's actually doing in terms of maximizing control. And the question, I think, is whether there are 2 narratives basically on this. One is that Xi Jinping kind of has a phase plan. So he realized that the problems are incredibly difficult. There are a huge number of vested interests, as Steve indicated. So even if you want to do the right things, it's very hard to get them done. To get them done, you need to have a very large degree of political control. And so the positive or optimistic view would be Xi's basically focusing all his energy on getting maximum political control by the next Party Congress in October, November 2017, when there's going to be a huge turnover in senior leadership. And that once that control over personnel is firmly established, then you'll start to see a pivot towards much more aggressive and productive economic reforms. The negative view, obviously, is he's just interested in power. It's all about control, and once he gets the power, he'll just, seek to maximize control. And we don't know which is right. I think we'll know in about 18 months once that party Congress is done.
John, one very, very short question because we're out of time.
How does China's sort of overseas trade adventurism, the One Belt, One Road, and these new financial institutions building lots of infrastructure in Africa and trying to open markets for Chinese goods, investing overseas, how does that fit into this picture?
Okay, I think this is a little bit complicated. So first of all, One Belt, One Road, I think is, to some extent, it's just like an advertising label that has been stuck on a bunch of stuff that was already occurring as a way of organizing it conceptually. I think there are also some clearly, efforts to strategically funnel more funds through mechanisms such as the Asia Infrastructure Investment Bank and the Silk Road Fund, but more through the development banks. China Development Bank and the Export-Import Bank are much, much larger players in terms of flows of finance. I think some of that is very positive. I think there's a very strong case for improving connectivity, particularly in Southeast Asia, where you have very large populations, some of them prosperous, some of them not, and horrible infrastructure. You can't get from one place to another. So I think a lot of that probably in the long run will be pretty productive. Central Asian stuff, maybe less so. I think the question is, how much of this is driven by sort of economic interest and how much is driven by a more straightforwardly political interest to increase China's sphere of influence and carve out, a space in Asia where it really is the dominant player. I think it's some of both. I think the rhetoric around this sometimes, particularly in DC, gets a little bit overheated, and I think people spend a little bit too much time fighting about the strategic elements, which are debatable and I think will be hard to execute on, and just ignoring the fact that some of this money is clearly going to be wasted, but some of it is probably going to generate some positive growth externalities. And I think the reflexive negativity towards this is probably not the right approach to have.
This discussion has given you a flavor of what is in this book. It is for sale outside, and the author is here to autograph it. So please join me in thanking Arthur for a wonderful